Hello everyone and welcome back to another week in markets. This week we are going to focus in on the US. Delighted to be joined by Sam Elliot, an investment analyst here on the investment desk. Now, with the US still in shutdown, there is one part of government which is still operational, and that is the US Federal Reserve. And they met this week for their scheduled 6-weekly meeting, and we can bring you the latest news about that interest rate decision. Over to you, Sam. What was the decision from the committee?
Thanks, Kevin. Yes, as you say, the Fed met on Wednesday this week, and as was expected, they reduced the US interest rate by 0.25%. So that was what the market was expecting ahead of the meeting. But I think what was actually quite interesting was just the split of votes within the committee. So we had dissent on both sides. So we had one member voting for a bigger interest rate cut, and we actually had one member voting for no cut at all as well. So that was the first time in 6 years that we've had dissent on both sides against the majority decision.
So highly unusual to see that type of dissent. It's actually something we've seen from the Bank of England recently as well, which does show that some policymakers are a bit conflicted about cutting interest rates with inflation still above target. So I did mention, Sam, that we're still in the US shutdown. How do you think that this remaining in the shutdown influenced this decision?
Yeah, it's really the difficulty of the uncertainty of the lack of data which is coming out. So if you think back to August, we had the Jackson Hole Symposium, where Powell, the Fed chair there, set out the path of cutting interest rates based on cooling labour markets, so softer data within the jobs market. And obviously, in the last 6 weeks or so with the shutdown, we've not had any data coming out to challenge that. So they remain on this path of cutting interest rates. But I think we've seen within the members that some are more focused on inflation, hence the one member voting for no change there, whereas other members are more focused on that cooling jobs data. Yeah,
so it's important to tease out that US jobs growth was slowing and in fact was near zero going into the shutdown. And as you said, Sam, that speech from President Powell, or Chair Powell, at the Jackson Hole Symposium really did, I suppose, mark a turning point, that they were now more focused on the jobs part of the mandate rather than inflation. And so that's why the majority of the committee delivered the rate cut in September. I've now followed through with another one. So one of the issues that we're obviously looking at, and it's been very good for portfolios, is the fact that stock markets are at all-time highs. So how do we think about the conflict there, which is there doesn't appear to be much beyond slowing jobs growth to worry the Federal Reserve?
Yeah, it's really interesting to see that come through, that dynamic. So we have had slowing in hiring in terms of the jobs data there. We've also had a couple of companies in the last week or so announce job cuts, the likes of Amazon and General Motors. I think that was referenced by Powell in his press conference last night. But actually the unemployment rate has barely moved over the last 12 months or so. So I think it was 4.2% back in November of last year. It's 4.3% on the latest reading in August this year. So really not seen a rise in unemployment. And I think the equity market has looked at that, and that's been one of the reasons where the market's driven higher. Yeah. But also the robustness of corporate profits as well. That's really been a key driver also.
So we've very much got the AI investment boom continuing, and that's driving profitability. As you said, we've only had a modest increase in unemployment over the last 12 months. In fact, it's been close to zero because it's a statistically rounding error. But what the Federal Reserve are aware of is typically when unemployment does rise, actually it has historically led to recession. So they're trying to get ahead of that. And these are sort of insurance cuts that they've delivered so far, and the market expects more into the end of the year and certainly through the first half of next year. Okay, so that's what the Federal Reserve has done. The other news overnight, of course, is that Trump once again is dominating the headlines with a US-China trade deal. So what can we take from that?
Yeah, so Trump met with Xi Jinping of China in Korea. That was the first time they met face-to-face, I think, in 6 years. It was really positive development. So the US agreed to cut their tariffs on fentanyl-related goods from 20% to 10%. So that was a positive on the China side of things. And for the US, China agreed to buy the likes of soybeans and other farm goods as well. So positive for the US farming industry. And Trump also indicated that there was more talks to come on semiconductor exports as well.
Yeah, so for those of you with a long enough memory, this is almost exactly what we went through in 2019, which is a trade deal was shaped between the US and China China agreed to buy more soybeans. They didn't back then, but perhaps that's one of the reasons why this trade deal has a 1-year expiry on it. It gives the US a chance to revisit this time next year. But it's good news. We have stock markets remaining at all-time highs, although they had priced most of this good news before this event. So a very positive backdrop for markets. Again, the Federal Reserve following through with an interest rate cut. Thanks to Sam for participating this week. That's all for today. Please do like and subscribe on the YouTube channel, and we get to look forward to a new month beginning next week, where we'll update you on the week ahead, particularly with regards to UK data. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.